Mark, very good afternoon to you. Thanks for joining us.
Yeah, thanks for having me.
What are the key levels you're watching on the rates curve as to whether we're likely to see a significant break higher or lower from here?
Well, I mean, we've been breaching a lot of key levels. So we broke 2% last week after the Trump, additional 10% tariff risk hit with regards to China. We were down near 160 on the 10-year earlier today, and we've subsequently backed up a bit. So we've gone through a number of key technical levels in a very short period of time. And I think that what the market is really reacting to are uncertainties with regards to trade, the global backdrop, what it means for currency wars, and also what the Fed is going to do in the face of all this uncertainty. And from the rates market perspective, I think the bias is to expect lower rates as opposed to higher rates, at least until some of these uncertainties are cleared up.
You know, PIMCO put out a note this weekend, Mark, that we could expect negative rates in this country. Is that something that you guys are contemplating there at the BofA desk?
It's certainly not our base case scenario, but it's a risk that I don't think that we can completely rule out. Because if we do end up in an environment where you've got a lot of persistent trade uncertainty, where global growth slows, there's a race to the bottom, so to speak, in terms of currency wars and intervention, then the Fed is going to have to cut rates quite close to zero in that type of environment. And if they do, depending upon what the rest of the world does and how the global backdrop evolves, it's not crazy to think that you could be looking at that type of environment. Now, again, that's not our base case, but the fact that we've seen rates fall as much as they have recently suggests that that low probability event is increasing, even though the odds are still quite low. But it's an increasing risk that the market, I think, is going to have a harder and harder time discounting.
Hi, Mark. It's Josh Brown. In the spring of 2016, finally, rates had really put in a bottom, and that was right around the time where people were saying we're going to 0%. I think the 10-year hit 1.3, and it was just as much negativity as there is now about global growth. And then all of a sudden, things changed on a dime with Brexit and then the U.S. election a couple of months later, and then all of a sudden rates were rocketing higher to the point where last summer the consensus was for 3 rate hikes throughout the course of 2019, and some firms were pricing in 4. So don't you agree that a lot of the commentary coming out now is just a function of what's happening with prices, and that once prices change, the narrative changes just as swiftly? Isn't there a lot of that happening today and this week?
Well, I think that what is happening is that you just have a lot of uncertainty with regards to how the global backdrop evolves, and most of it stems from trade and trade policy uncertainty. Now, it's very plausible that if you get some type of trade resolution, let's say Trump and Xi are able to strike a deal, which the market is heavily discounting at this point in time, you should see rates back up meaningfully. Even if there is just a status quo from where we were, let's say, at this time last week, we think that rates would be higher. 2% would seem a lot more reasonable than where we are on the 10-year at 1.7%. But I think the market is worried that there is really no end in sight. And all the news flow seems to be suggesting that trade could get worse as opposed to better. And if that's the case, then you're going to have more of what you saw overnight. And that's you had a lot of central banks cutting. Right? The RBNZ cut more than expected. That is going to fuel concerns over currency war and a race to the bottom, so to speak, in central bank policy rates. And if that happens, then all of a sudden you're going to be looking at interest rates which keep moving lower, where you can have further negative yielding assets in Germany, and you can see long end rates continue to fall and the curve potentially to flatten in the U.S. So I hear what you're saying. Maybe the market is a little bit overdone, but it needs something to help itself believe that there will be an end to the uncertainty and at least no longer a worsening of trade tensions, and hopefully a Fed that begins to sound a bit more responsive to some of these concerns.